Hello, everyone. Thanks so much for being here. We have a very special guest, Andrew Levine. He's the head of S&P Trading at Blackedge. So thanks so much for being here. It's I know right now you're not in your offices, but the markets are still open. So uh, will be great to hear you.
Thanks. Well, first of all, thank you for having me. These are always, nice things to have, presentations like this where people can get together, particularly now. I'd say generally speaking, they're good. Trading, finance is a niche industry, and trading especially is a niche industry. And then if you add options on top of that, that's the part that I'm in, which maybe not everyone is necessarily involved with, but it's even further segmented. So doing these things, particularly with the backdrop of COVID and everyone working remotely, is a good way to strengthen the ties of the financial community and the trading community at large. So thank you for having me. I really appreciate it. I thought today, I'd talk a little bit about sort of the history of options and how the shift, the migration to electronic trading and options has evolved over the last 20 years or so. And I thought that with the idea of everyone working remotely from home, that would be a very interesting sort of topical thing to speak about, just given everything that's going on. So first, I'll give you a little background on myself. I've been in the business in options trading my entire career, essentially. I joined out of college from the University of Michigan in 2003, so you can back out what my age is. But I started as what I would call a very traditional path for anyone that's in a Chicago market making firm, which is starting out on the floor as a trader's assistant. And that is the nice way of saying a clerk. So if you ever watch, any of the movies, or you're familiar with the trading floors, you'll see everyone in their various jackets, obviously yelling and called ARB, sign language, to each other, to communicate trades. And then the people in, depending on what exchange you are, might be in a different colored jacket, is usually signifies a clerk. So sort of the lowest rung on the ladder. But as a company I worked for was, it's a mid-sized market making firm, and I worked for them for quite a long time, probably about 12 years or so. And they had a good trader and sort of training program. And so I did that. I clerked on the floor in mostly NASDAQ options for about a year or so, and then eventually became a junior trader and traded in the Russell 2000 options pit. And I was actually a specialist at one point. The CBOE calls it the designated primary market maker, which is a DPM, which is effectively a specialist. And then I was eventually invited to go trade upstairs for the firm, which was really sort of a burgeoning avenue for trading at that time. When I first started, options were probably 80% traded on the floor and maybe 20%. I mean, it might not have been that much at that time, traded electronically. And I'll go over some of the reasons why that was and why it's actually shifted so dramatically over the last few years, and why it's lagged some of the other asset classes like futures and stocks. But in any case, I went and I traded as an electronic market maker. I was actually one of the first electronic market makers, the first in our index products at the time. There was a small equity division. Did that for a few years, and also traded with brokers via chat and telephone, and so really handled a lot of the upstairs operations, and eventually took over a product group, usually in sort of typical fashion. Market making firms have traditionally segmented their options desk by asset class. So you might see US equity indexes, and then that might be sub-segmented into SPX or NASDAQ or Russell. I took over the Russell at the time, and then eventually took over a metals group. So that was sort of my path, kind of like starting as a trader and then eventually becoming a desk head. And my current role now is the head of S&P options market making for Blackedge, which is a firm that actually got its roots in the firm that I originally started at. The founders of this company were actually traders there as well. So that's where I'm at now, and enjoying it. It's a great company to work for, and in they've actually been ahead of the curve, I would say, in terms of remote working. If you had asked me a year ago, before I started here, I've been here a little over a year, I would say it would be impossible to trade options from home. To give you an idea, my setup at work is 12 monitors. So it's a lot of screen space. You quickly find out that you can be a lot more efficient when you have to be. I learned that very quickly. I have 4 main ones at home and 2 off to the side. So I basically scaled down by about half, and I've made it work. So that's good. But Blackedge is actually, they have a lot of remote work, and they did have remote workers early on. So it's one of those things that it's kind of it's a younger company, and so thinking about those things as more of an employee perk really translated well into this environment. When a good percentage were already working from home, it became sort of an easy transition to just let everybody else work from home. And in fact, no one's required to go back to the office for over a year. So I mean, we're really comfortable, I think, in that regard. I think some of the other firms, just talking to the industry with some of my friends, felt like it was a little bit of a rush to get people set up at home, but it does seem like everyone's sort of settled in and is making it work. So it's very interesting that you never waste a crisis, so to speak, and we'll see how the exchanges react to it, to the idea of closing the floor and the physical space, and all these offices closing their physical space as well. But it does seem like it's definitely possible, where maybe a year or 2 ago it didn't seem like that was a very good idea. Now it's certainly, business is running probably at 90% capacity. So it's definitely possible. So I thought that it would be interesting to talk about the evolution of electronic trading in the context of that, because so much of it is electronic now. That's one of the reasons why it's so, it's been as seamless as it has been. But it wasn't always that way. And if you think about it, we take for granted now everything is electronic. If you think about your home brokerage station, I don't, whether you use a Charles Schwab or you use a more traditional broker or Interactive Brokers, it's just normal. That's what you do. You click a button and you can trade electronically. And so, and options are that way now, but realistically, that it hasn't been that way for very long. I mean, probably only about 10 years or so have options really been electronic, versus stocks and futures had been electronic for a lot longer. And so one of the interesting things that we think was, well, why is that? And the first is, just generally speaking, options have really moved into the mainstream. So if you watch CNBC or Wall Street Journal, the volume of articles on options has increased dramatically over the last 10 or 15 years as well. I mean, before, maybe a little blurb in a section in the back of a Wall Street Journal article, and that would be the extent of the options coverage. But now it seems like it's everywhere, and it's pretty ubiquitous. And if you turn on CNBC at 4 o'clock, there's the Fast Money Show, and there's always an options play on there. So just generally speaking, I think the awareness of options has increased. And then the education surrounding that has also increased. There are plenty of books. When I started, the only book was, you read Sheldon Natenberg's Option Volatility and Pricing. So that's still my #1 recommendation if you're interested in learning about options. I actually studied under Sheldon. He worked for the company that I had worked for a long time as the head of education. So I had a great experience with that. And his book to this day is still considered the Bible of options trading. But if you look at that was the book. That's what everyone read. And maybe there were a handful of others. And now there's volumes of get started with options type books that exist, that just didn't exist that long ago. And so part of it is just the general education has increased. And so just to give a little history of options, so everyone's familiar with it, options are based on the Black-Scholes formula, which is named for Fisher Black and Myron Scholes, who developed the formula. And I actually believe it was a heat dispersion model. That was a formula for like how a candle disperses heat throughout a room. And they eventually applied it to options trading and realized that, you know, you can boil down all these sort of fundamentally unknowns in options to really only one unknown. And so if you read about options, you'll find that there's the, you know, the strike price, the underlying price, the strike price, timed expiration. Those things are all known. Interest, dividends, and then what is the volatility? Well, interest and dividends, for the most part, there is some discounting associated with options premium, but the most part is figuring out what the forward vol of an option is, or the forward price rather of an option is. So on a CME future that takes place in SEP, well, you know what the future price is. That it's, I mean, maybe that isn't the correct future price, but you can certainly trade it, and as long as you can hedge that risk, that for all intents and purposes is the future price. But essentially, you have a handful of things that are known, and then this one thing that is relatively unknown is, you know, what is going to be the volatility of the underlying over the life of the option. And if you know what that is, what Black-Scholes formula says is you can replicate that option in such a way that you can capture the underlying volatility. So what options market makers do is they take what is most likely a delta bet, meaning the stock will go up or down, and turn it into a volatility bet, which is a little bit more stable. It gives you time to potentially get out of it, and also can equate the entire surface a little bit more meaningfully than potentially direction can. And so that is how really broadly options market makers trade volatility. Well, before Black-Scholes, options have been around, they existed. If you read books from the 20s or 30s, they're talked about as this very esoteric type trade or type asset that is not very well priced, is probably really illiquid, and is, you know, I would guess it was very subjective to whoever was running some, you know, bank desk or trading desk that basically, you know, priced it kind of thumb in the air. But this formula essentially said, well, we can actually figure out what it's worth, and we can figure out, you know, in a very particular way what it's worth. And so that they published that in the early 70s. And then once that happened, options really sort of, I wouldn't say exploded onto the mainstream, but certainly that was the birth of options into the mainstream, into trading. The CBOE, the Chicago Board of Options Exchange, was formed. For a long time, that was the only options exchange. Now there's, you know, I don't know, 15 or so. I mean, there's just a new one every few months, it seems like. But you know, that really allowed options to come into existence. And so if you really think about it, options are really not that old in general. I mean, we're talking about 50 years where they've really been traded heavily versus stocks. That, I mean, you know, go back, you know, thousands of years, I'm sure there's some version of stock. I mean, maybe you can trace it to the you know, Dutch East India Company. Was that the first one? I'm not sure, but, you know, even hundreds of years, you know, stocks have just been around for a long time, and even futures have been around for a long time. So in some sense, there's a little bit of catch up that's been played. But, you know, as people become more aware of options, it's very clear that they're, you know, here to stay, and they're becoming part of main branch of trading, not just a small corner of trading that's reserved for purely professionals. I still recommend, if they're far more advanced than a regular stock. There's a lot more inputs, you know, even if it's boiled down to a few. Understanding them all takes a little bit more education, but at the same time, all those things are becoming more readily available. So what was once very difficult is now becoming a lot easier to get your hands on that kind of information and understand how to trade them. So that's part of it. The other piece is, if of why they were sort of lagging, is just the general complexity in calculating it. And so I'll tell you a story, which, again, I already gave away the date that I graduated from college, so this, you know, might continue to date me. But when I first started on the floor, we, you know, handheld computers, so we're not talking about laptops, but actually like touchscreen computers that you would think of like your iPad now, were pretty rare. And although I did have one, it probably broke every every few hours, and I had to carry around. The battery probably weighed 10 pounds. I mean, it was. I carried extra ones for both myself, and when I was clerking, I had to carry 3 for the traders. I mean, I was just loaded down with these heavy batteries that had to be swapped out every about. I mean, it felt like an hour, but I'm sure it was, they lasted maybe 2 or 3 hours, but. Um, and what I carried in my pocket, in my interior pocket, were trading sheets, which for years was how people traded. And they were just long, very tall sheets, like taller than a legal pad, that had your values, the values for every option versus various future prices that were printed out on paper. And you would just look at it. And that's how you would get your option values, versus the handheld obviously was live ticking and had a grid of your sort of a virtual representation of those sheets. But that was very new, and that was in 2003. I mean, we were probably one of the few firms that actually had handhelds. Most people down there still had sheets. And the other thing I'll tell you is to give you an idea of just how cumbersome sheets were, not only to flip them, but they took forever to print, because you had to set up your computers to do it. I mean, I would hear stories, from people from maybe 5 years ahead of me that would say, "Oh yeah, we could only run sheets once a day, really, because it would just take hours to run all the calculations for all the options, and then printing them out, it would just take too long." So typically, what would happen is you do one sheets a day, and that was it. And it was always sort of a brutal slog to be the clerk in charge of sheets. That was like one of the sort of the duties that was part of the low rung on the ladder, is you had to print these sheets out every night. And it was obviously a rotation, which was nice. I don't think I would have lasted in this industry if I had to do that every night, because it took about 2 hours to print all these things. And of course, then you had to add on that every trader wanted them in a very particular way. So, some wanted a vertical staple, some wanted a horizontal staple, and if you got it wrong, it was big trouble. So, not just the actual act of calculating and printing out the sheets, but doing all that other stuff was something I look back on. I guess it built a lot of character, let's say that. And eventually you got to midday sheets. You could run them, but still, it might take 30 minutes or so to calculate these things. And so what, traders, when you think about why traders are good at mental math, particularly options traders, well, it's because you had to keep track of everything that was trading off some reference that might have been from hours ago. Or if your futures run off your sheets, what do? Well, you just have to make the adjustment with the last page that you have. And so, that it was very challenging to trade on them. I was very happy and fortunate to have a handheld that worked most of the time, despite the fact that it was heavy and slow and and cumbersome. Now, by today's standard, I mean, you use a Microsoft Surface, or there's a company, I forget which company, that tends to make these things pretty well, but it's like driving a Ferrari versus what we used to have. So part of it is just pure computing power. The fact of the matter is, to calculate options it takes a decent amount of computing power to run all the simulations, and then depending on what type of option it is, and the method by which you calculate them, it can take even longer. Some people, I don't know if you've heard of binomial trees. Those things can take, depending on how you run them, it can take even longer than just regular sort of simple calculations. And so what you found is that people always look at electronic trading and say, well, or I should say, so a lot of people, when they talk about high frequency trading, conflate high frequency with electronic trading. And high frequency definitely gets a bad rap, probably not from people within the high frequency community, but there's certainly a lot of negative publicity, or has been negative publicity in the past regarding high frequency. And a lot of times high frequency traders go out and they defend themselves by saying all the benefits that high frequency trading provides. But the reality of it is that's just electronic trading. I mean, they can take credit for a lot of the things that electronic trading and just the connectivity and computers have really contributed to the space. That's not to say they don't provide a service. I'm just pointing out, when I talk about electronic, try to segment that out. But if when you look back, how much computers have evolved over the last 15 years, it's astronomical, and just the connectivity associated with it is really big as well too. And so when we talk about options and you think of all these calculations, the reason why, or one of the reasons why it's so expensive from both a calculation perspective and a connectivity perspective is because there are so many instruments. A stock is a single instrument. You can create one order book. The exchange creates one order book per stock, right? And it's very simple to create. I mean, for those of you that are taking, or I'm not sure where everyone is in their careers or in life, but if you've taken a financial engineering program or in the midst of one, what nowadays it's not uncommon to actually create an order book or even a programming class. Those are sorts of things that are much more common, and so the creation of an order book is not overly complex. But now, if you look at the future, okay, there's maybe a half a dozen contracts. It's a little bit harder, but still on the same order of a single contract. But then finally, if you look at options, there are thousands of instruments per stock or per asset class potentially, and it just depends on what the actual underlying is. But it becomes an exponentially greater problem. So it's an order of magnitude higher than just a single order book. You have to create an order book for all those things, and then the real big kicker comes in when you talk about RFQs, which are request for quotes, or what's also called a user-generated spread. A lot of options volume is actually traded via spreads rather than just the outrights themselves. And the exchange is in the customer service business to some degree, and they want to make access to options as open as possible and give customers whatever they want. And so that's one of the great aspects or benefits to trading options is there's enough availability of outrights that you can really cater sort of any type of insurance, whether it's portfolio insurance or just payoff structure that you really want. And you can generate anything. There's literally an infinite number of spreads that you can create, and the exchanges with a very small amount of restrictions or limited, they don't really limit you beyond a few very basic restrictions, and so it allows you to create anything you want. And we actually even hit the limit, and they often don't delete them either. If nothing trades, it just sits out there and it'll be there, and there's some cleanup process, but for the most part they leave them out there. And we sort of inadvertently hit a limit that was just sort of arbitrarily set. It wasn't a real limit. It's just suddenly thinking, yeah, we'll never see 100,000 contracts. And of course, with the pandemic, there were 105,000 contracts. We were trying to figure out what was going on, and so our tech department was, they're very sharp, and they were on it, and they said, yeah, who knew? Who would have thought that we would have hit this? And so we just raised it. No big deal. It wasn't, anything that had to be there. It's just sort of something that was sitting there. And but that just gives you the idea of scope in the SPX complex. That's the SPX options and in ES options. There were I think it was like 106,000 total instruments. And so that's a lot. I mean, it's a lot of things to keep track of. So the exchange has to keep track of it. And just for us, we have to keep track of it, of course, too. And so now if you start thinking about, well, now let's talk about connectivity. So not just calculating all those things. And by the way, the exchange typically makes it available or makes available the ability to link things together. So like if you were to put in an order that might interact with one, or I should say, you put in an order in a spread and it can be executed via the legs of the outrights, they'll link that together. So it's not just 105,000 separate instruments. They all have to be connected to each other. And so that makes it, again, even more complex. They're all sort of an intertangled web. So now if you think about that's probably the largest complex is 105,000, but I mean, there's 3,000 different stocks. There's, hundreds of different futures contracts. And if you look at like the opera feed, which, someone quoted me, this may or may not be right, but it sounds plausible. It sounded plausible to me at the time, but the opera feed is like the largest live ticking data source in the entire world. And if you think about what it is, well, thousands and thousands of contracts. So we're talking about, I should say, thousands of underlyings. And then on top of that, tens of thousands potentially per each underlying. And then on top of that, everybody has to submit a bid and an offer for each of those. And then you have, maybe 100 participants, or probably not that many for everything, but, certainly you could have that for some. Like, you can see how that just adds up and adds up and adds up. And all of that flowing back and forth, over the course of milliseconds. I mean, we measure things in microseconds now, and really even to nanoseconds at some point. That data doesn't necessarily flow that fast all the time, but the idea that you have all these market participants updating, that volume of data at any given moment, and then the exchange has to process it. You can see how it's not as easy to create an electronic exchange as a simple stock exchange, where there's just not that level of data. So the connectivity piece, in terms of being able to transmit that data, in addition to the processing of that data, and all the advances that have been made in the last 15 years in that front, have also allowed the electronic exchanges, where they really just couldn't exist 15 years ago in the same way that they exist now. I mean, they certainly did, but not to this level. And really, the spread piece was the one that, when I said there was probably 80-20, 80% traded on the floor of the exchanges, or trading floors, and in open outcry, and 20% was electronic. Probably of that 20%, 95% of it was outright or something along those lines, just because the spread capability wasn't there. But clearly that's changed now, and obviously that's flipped. I don't know what the exact numbers are, and it's, by product it's different. I mean, equities are probably very close to 100%, because there's just not a trading floor anymore for most equities. There still is technically, and there are in a few places, but the reality of it is, it's, they're usually used as crossing exchanges for equity products. There are a few pits that are left that are big. Pre-COVID, the largest one is still probably the SPX. There's, I'm not sure, maybe 300 people that stand down in the pit and trade. And in fairness, it's a pretty efficient way. If you think about all the volume that trades, in there, it's trillions of dollars a year, goes back and forth notionally. And, it's a $3,000+ index, and, you can find a dime wide market. I mean, it's a pretty efficient system to have everybody in one spot. And over the years, there's, I'll probably get a little off topic a little bit, but there was this race to centralized liquidity. And if you think about maybe the 1900s, the early 1900s, you had various exchanges, where you could trade stocks. I mean, for stock, there was primarily the NYSE, but really, maybe you think about it in futures markets, stitching these markets together. There's still things like Minneapolis wheat and Kansas City wheat, and there was arbitrage for geographically speaking. And what you saw in sort of the latter half of the 1900s is the centralization of all that. Trading volume into several key exchanges, and that's really efficient. Of course, there are people that will say, well, there's detractors. If you're an insider, that obviously benefits whoever is an insider at that institution. But at the same time, you can go to one spot or call in, use the phone at the time, and actually execute whatever you need to execute. And then, of course, with electronic trading, that opens it up even more. But what you found over the last 20 years or so, the proliferation of exchanges has gone the other way. And so, some of that is born out of a desire to cross orders with customers, particularly on the option side. Banks that often trade with their own clients want the ability to trade. Well, if they're going to give up edge and pay the offer, my trading desk wants to do it. So there are all sorts of rights that market makers are afforded on the CBOE, that if they make a quote, they're allowed to participate, so they can't be shut out. I mean, they're providing a service, so that if you're going to trade something there, they should be able to participate on it, and that's the thought. And a lot of exchanges were actually backed by large institutions that wanted to create their own exchanges so they could geographically split people and cross them. And if you actually think about it, at the time when I was an upstairs broker, trading with upstairs brokers, it was a game of whack-a-mole sometimes, that the brokers would get frustrated about where they could put up orders, because they were always worried about getting blocked by floor traders. And so oftentimes a lot of large institutions who had potentially stakes in some of these exchanges and also some of the brokers would sort of lobby to get the pits split up. So if you wanted to have representation on the exchange, you had to send more people down there to do that, and that became kind of cost prohibitive. So it's sort of an interesting dynamic what's happened over the last few years in terms of the proliferation of all these exchanges and sort of how it's decentralized the liquidity in many ways. And then, the SEC has basically said, yes, we're going to approve all these exchanges. However, you guys have to work it out amongst yourselves to basically connect each other or connect to each other. And, that's where all this routing comes from. And so if you look at the premise of Flash Boys, a lot of that is sort of, I'm not sure how many people are familiar with that, but, a lot of that it has to deal with the idea that these exchanges are separate, and how you time your orders to get to the exchange becomes a new game, and all those games that are played in various forms still. But the reality of it is a lot of that is born out of the idea that the liquidity was just fragmented across a number of different exchanges. So it's a little bit of a digression from how options have increased in terms of or how option volumes have been reaching record highs, but kind of a fun fact that I thought would be interesting. And I'd be happy to talk more about some different games. One thing I'll tell is, which is another interesting piece, is now it's not just if you look at that book, which is I think that they were dealing with spread networks in that book, which was a fiber optic line between Chicago and New York. That's dated. That is, that was actually probably dated by the time the book went to print, which just shows you how fast it's moving. And microwave is sort of the new, microwave towers is sort of the new fiber optic line. And I actually worked for a firm for a year or so that had a division that built a microwave tower, and I think it was in Nova Scotia, and another one on the other side of the Atlantic, off the coast of England, and they had to build it tall enough, to deal with the curvature of Earth and, for direct line of sight. So that, to shave off, we're talking microseconds. And so it's interesting because now everyone's on microwave. And so what's the next thing? And people, I think, are, talking about low Earth radio frequencies, but, weather can get in the way, but it's really fast. And some of those, it's going to be something that's next. But one of the things that you can do, or that people often do, is try and almost like game the exchange's order book to some degree. Because if everyone's getting to the exchange at the exact same time, there are different tricks that people can, sort of tune their systems to do to basically get priority. And we have to, unfortunately for us, usually this is bad for us because we're sitting out there with all our quotes, and it's sort of a tax on us because, unfortunately, we have to sort of respond to that. We have to, if someone can beat us to our stale quote before we can, it's something that we just have to address. And so, like, an interesting idea, which I don't think is relevant anymore, I think they've changed it, is the idea of, like, what would be called warming the ports. And so the example is, when you're thinking about a processor, you don't just add processors necessarily to make your computer faster, but working on the efficiency of how that processor handles different things is another way to make it faster. And so there's, I think, entire swaths of computer science that's dedicated to this very field of study. And the example that would give is, like, if you think of the exchange is an elevator in a building, and the building, let's say it's Friday night at 8 o'clock, and the building is mostly empty except one company on the 10th floor is having their corporate party, let's say. Well, what would you do to optimize the elevator? If the worst thing is that someone pushes the button and they have to wait, you want to minimize that time. Well, as soon as the elevator goes to the lobby and deliver someone to the lobby, this is one way that the processors can be tuned, and in the way that most of the exchanges are tuned, because they're based on Linux, and this is like a Linux thing. It says basically, well, look at the last thing I was looking at, and so the elevator is going to go back to the 10th floor, and wait there at least, because the reality, or the likelihood that someone's coming off of the 10th floor is high, and so I can minimize my time that way. And you can think of it like your app. If you open up an app on your phone, you're looking at Google Maps, well, the likelihood is that you're going to look at Google Maps again before you look at something else. So keep listening to that port essentially. And so what, some people figured this out, and they would send little dummy messages to the exchange to get the exchange to basically be continuing to listen to them as much as possible. So when they needed to send something for real, they could just follow it up with a quick message. And so there was all sorts of little things like that that continue to exist. And the exchanges do a pretty good job. I think it's a really hard problem to solve, because it's like anything else. Everyone's always trying to find the next game that they can, you can write a rule to eliminate something like this, or change maybe a protocol, but at the end of the day, someone's going to stumble on the next one. And so it is a little bit of a game of whack-a-mole to try and keep everything on the level. But again, that's a little bit of a diversion. So that's essentially really what's driven a lot of this electronic volume. The last piece kind of goes hand in hand with sort of the popularity of options, and the rise of education around options, and that's volatility funds and volatility related products. Everybody now probably knows what the VIX is. Again, something like the VIX has really only been a tradable product for maybe 10 years or so, maybe a little bit longer. I can't remember exactly when it first went live for trading. It had been an index simply for sort of tracking purposes for years before that, but then the SIBO figured out that there's a lot of interest in it, and they can actually monetize it and turn it into a tradable product. And so of course they did that, and it's been really popular, and they own the patent on it. And so there are a lot of other funds that are trying to compete and take the share of trading revenues associated with that. And so they've launched their own funds, and there are plenty of funds that, not everybody has access to futures, particularly retail traders or people with just regular investment accounts. And to the extent that they want to invest in, I hate to say invest, you don't really invest in volatility. It's not an asset like anything else, but it'll certainly at least trade volatility to some degree, or use it as a hedge. Then, there are all sorts of ETFs associated with it, that actually buy the ETF, or sorry, that buy the futures and roll them. And so like any other sort of ETF that does that, like the oil ETF, which I'm sure everybody's familiar with now if they've seen, went negative at one point, that similar style of ETF exists. And then, and really also, if you really want to get into not investing, but effectively gambling, are the ultra longs and ultra shorts and triple longs and triple short levered funds, which, by the way, if you read the prospectus, is guaranteed to go to zero at some point because of the nature of the returns. So just keep that in mind if you're ever interested in trading those. Those can blow up very, very quickly, and many of them have. And if you ever look at a reverse or a stock adjusted, I should say split adjusted price of those things, I mean, they'll go down to a nickel and then do a reverse 10,000 split or something like that to get it back up to some price that they think is makes it tradable for the public. So, but those things have risen in popularity as well. And they're just part of the mainstream now. And again, it's like, what's one of those things that there was a Wall Street Journal article a couple days ago even that just came out that was detailing some of these products, and that's just common now. I mean, we see that so much. So a lot of these funds are actually, essentially what they're doing is they're aggregating retail options volume and then going and executing it potentially in the future space or in the option space, and doing things like that. So that's also contributed to a lot of the rise in volume. So oh, and the last piece too, which I thought was interesting, is which I'm not sure how big it is, the tail risk funds have come in. It seems like anytime we get these negative moves or these large moves, it is a great story to hear the bet that returned 2,000% in a month. And of course, you never hear how much premium they paid or what percent they paid out the 2 years before. I am actually generally a believer that tail risk is undervalued. It does take a lot of capital to be able to hang in there and stay with it for a long time. But those funds also have seemed to rise in popularity as well. And so I think they're also executing a lot of options, and it's just more along the general trend. So the real question now becomes what's going to happen now that the floors are closed. And the floors have been closed for, since I want to say March. There is a slow reopening of the floors with not really a lot of caveats. I mean, there are some things that they're doing to protect everybody, but the reality of it is it's pretty hard. I don't know that it's possible to socially distance in some of these pits where, you were literally standing shoulder to shoulder with somebody if you were a trader in that pit, a few months ago. Even if you reduce the number by 50%, I mean, you might be standing a foot or two away from somebody as opposed to literally touching them. So, how that is going to work is unknown. But, I do think that what's interesting is I was kind of 50-50 on whether the exchanges would use this as an opportunity to potentially extend the closure and see if they would try and eliminate the pits altogether. I think the few pits that are left have a lot of stakeholders that definitely want the floor and want to continue to be on the floor. The exchange, for the most part, I think, as long as it's reasonable and cost effective, they tend to seem okay with it. And in the last pits that are left, it probably is reasonably profitable to some degree. If they're able to even consolidate some of the floors that are empty and try and put it into a smaller physical space, I'm sure it'll even make it make more sense then. But I remember when when I was trading gold and they closed the floor, it was the NYMEX, which is owned by the CME, closed the floor. And there was a lot of speculation on if they do it because that pit actually traded a lot of volume. It was one of the last pits that had a lot of volume going through it. And, they basically just made the decision, well, none of the other pits have any volume, so this is going to kind of go with it. And, I think at first it definitely, there's some disruption associated with it, but it didn't take a particularly long time, maybe about 6 months before it seemed like all that flow was able to migrate to either trading on the screens or trading via brokers over the phone. And so I would imagine that it's a likely scenario that the same would happen. Whether or not it will, it seems like they're going to stick with the floors for a while, just by nature of the fact that they're deciding to reopen them. But as I said earlier, never waste a crisis. If their goal is to actually close the floors at some point, this probably would have been the opportunity to do it. So in some sense, I guess it's a vote of confidence that they believe in the floor for at least a few more years by the nature of the fact that they're opening it. So anyway, that's a little bit of a background. I thought I would, hopefully it was topical. I'm happy to open up to any questions or follow-up. It doesn't have to be about this either, but if anybody has any questions, I want to leave a little bit of time for that. So
there's a couple of questions, but I would like to ask you a few. So when I was back in 2000, I think it was 2003, I was working for JP Morgan, and we were on the trading floor. There was this guy, I think he was the head of some desk, right? And can you describe a little bit how was the pits and how are the signs to trade? Because when I got there, and where the actual name broker comes from as well, which is the guys that are just outside the pit and they take orders from the people that were on the desk, and how crazy it was. Hectic. I know the guy that I think he had 4 times vocal cords surgery because everyone's saying, right?
Yeah.
And can you tell us a little bit how that was like? Like signs and
Yeah, so it looks very chaotic, and in fairness, it is chaotic. It's less chaotic than it looks. So when most people, if you watch, like I'm again probably dating myself, but Trading Places is a great movie, and actually it's a very accurate sort of representation of what the floor looked like in the 80s. But yeah, so generally speaking, every exchange is a little bit different, but generally speaking, the way the floor works is you have traders that stand in the pit, and the way that the CBO would call it is a trader is usually someone that's trading for their own account, and then a broker is someone that's handling an order for somebody else. And the brokers have spots in the pit, and then on the outside of the pit, there are typically clerks, so people that support either the brokers or the trading staff. These days, it's mostly the trading staff. When I started at CME as an intern, as a runner, and so we would either sign the orders into the pit, or we'd actually run in there and deliver a piece of paper to the actual broker that was standing in there. But yeah, there is the sign language is important, because most of the time you can hear. It's not always crazy, but when it's crazy, you definitely can't hear. And so the only way to actually communicate is via sign language. And it looks ridiculous as everyone's flashing numbers across their faces. And it took me a couple months to learn it. I mean, everybody learns it. It's once you watch it every day, eventually you're going to get it. But it's all about the signs are depends on like where you touch your face. So like anything on your chin would be considered like a 1 or a 2. Anything on your forehead is considered 10. And then a lot of people have their own dialect of sign language. If you went into a fist, I would say then it's like 100, but technically your wrist is 100, and your elbow, can mean something else, and shoulder, really elbow is 1,000. Sell versus buy.
Right. Yeah.
Yeah. So, there's a little bit of dialect, and as a clerk, you learn to read all sorts of, everyone's own version of the sign language, because again, you have to. Sometimes you get yelled at if someone signs something that didn't really make sense, but that's just the way they do it, and so you'd have to pick up on it. But eventually, you just get good at it, and it's it's like reading a book. I mean, you can. It takes time, but and then it'll make sense. It's like looking at code potentially. Like if you're a programmer, it looks like gibberish if you've never programmed anything, and then once you sit down and learn how to program, it starts to make sense, and you understand it, and it no longer looks like gibberish. And so but yeah, it's a great experience. It's an interesting experience. If anybody has the opportunity to go back, or at least visit a floor, they still do tours, I'm pretty sure. Potentially not now, yeah, obviously as a result of COVID, but I'm would imagine that one day they'll open it back up. But even a few months ago they did tours, and you can call them and set something up, and it's a fun activity to see, particularly if you're interested in that stuff. And again, who knows for how long it'll be around. So I would certainly recommend, if anybody's interested, to try make an effort when things open back up to go see one.
So on the Peeptrade University Challenge, we partner up with the CBOE, and we took twice the people to the SPX, the Standard and Poor's, which it was pretty, it's still there. Not as it was in 2003, where I was a little bit scared, like with my hands on my pocket. I didn't want anybody to say, you take that trade.
Yeah.
And also, I remember very well, they had the weather channel for the futures and options on corn and soy. So it was like a box ring, right?
Yeah.
The corners you would have screens showing the weather channel. That's it for the futures of soybean. That those times will not come back.
Yeah, I mean, there's only a few. As I said, there's only a few left. I mean, there still is a soybean pit technically, and at the Board of Trade, the SPX is shaped like a diamond. Actually, is a lot of people would refer to it as first base, second base, third base, and home, sort of location of the pit. It's still, they think everyone still refers to it that way. But yeah, everything's a little bit different. But it's the SPX, I would say, is probably the last place, maybe the Eurodollar pit as well, the last sort of place where you can really see probably what you experienced, like the true trading floor that is still there. It's maybe not quite the same. There's a lot, everyone's more on chat now these days. And so maybe the hand signals aren't as important as they used to be, but it's, for the most part, they still do a lot of the same stuff. So
I think the guy that had his vocal cords, I think he's now working for the Mexican Stock Exchange as well. in the US. I was talking with the CEO of the Mexican Stock Exchange, and he mentioned that. But I don't know if that was a specific guy. Anyway, it was one of the best experiences I've ever seen. You know, like they took us inside the pit and see it was half and half. You know, so they were making arbitrage between the pit and electronic trading
Mm-hmm. Yep.
back. So it was a fun experience. It's sad that we won't see that again. I think. Anyway, it's great to hear your experience, and I can relate a little bit because I was a little bit there. And do you want us to take a couple of questions here?
Yeah, sure.
There's one that says, "Hello, Andrew. Do you see in the future that tools like Bloomberg will be accessible to general public?"
Um, well, I'd say the data is generally accessible. Bloomberg itself is pretty expensive. And I mean, at this point, I don't know. I mean, specifically that terminal, you know, it's depending on the add-ons. I think it's about $2,000 a month to have a Bloomberg terminal. So it's it's pretty pricey. So for the general public, I would say no to Bloomberg. But the reality of it is data is becoming more accessible. And so there are all sorts of competitors to Bloomberg now that exist. They're still really expensive. And there is some push by the industry to keep data expensive because it's a revenue source. So exchanges in particular sell their data, and they can sell preferential data and tiers of data because we're living in a data-driven world. If you look at what trading is now, or at least what is a major focus of trading versus, again, even 10 years ago, data is right up there. I mean, it's in everyone's face. And it's very important. And I've seen this over the course of my career, even though it's not been necessarily that long, but the pendulum shifts. We've seen similar things with modeling, and it shifts very far. Everyone wants the new model, and then it sort of comes back to sensor. And right now, the pendulum is shifting really hard to data. But that said, there are a lot of initiatives to try and free data. And so there are sites, I can't think of it off the top of my head, but I want to say like Quantopian is a site that allows you to actually like play around and with like Jupyter notebooks, their built-in version of them, I should say, I guess. And there's a lot of free data on there. Of course, you can subscribe to data, but the data then becomes something on the order of maybe $50 or $100 a month versus $2,000 a month. And again, with Bloomberg, you get everything. It's usually a bundled package, or you get most things you can add on, but you can pretty much get any source of information for that price. But of course, most people don't necessarily need that. And so if you just want to piece together data, you can go to Google and you can get certainly intraday data or end of day data is essentially free particularly for stocks now. But there's a lot of other sources that make data relatively cheap and available. And so I would start with Google, and you can always look, and there are cheaper sources. I do think probably as long as it has value, it'll continue to probably not be free, I would say. But I think I'm sure that might change, or I shouldn't say I'm sure, but it certainly could change 10 years from now, and maybe it's just so widely available. It's sort of a race like brokerage. Now it's free to trade, and it took Robinhood to do that. So every broker then has to compete with that. The same thing might happen with data if they can find a way to monetize the user in some form or another, or their accounts, or maybe it's just an open source project. If one person does that, it'll sort of be a race for everybody else to offer data for free. But for right now, it still tends to be you have to pay a premium for it. But there are cheaper sources than something like Bloomberg.
Yeah, and if you get a broker,
yeah, brokers usually offer it for free.
You'll be using real-time data. Real-time. What is real-time right now?
Yeah.
I don't know. There's another one here that says, with the pandemic of COVID, all the tools of Invest are floating a lot. Could you consider that options are better than stocks?
I think options are different than stocks. Really, options are, primarily they're designed for hedging. I mean, that's who the real end user is, who it's catered to anyway. Obviously, because options have leverage and you can make bets that you might not be able to make with just a margin on a stock, they do appeal to people who want to like lever their accounts up. That's very risky, of course, because depending on what your option strategy is, you could lose very quickly. There's no free lunch, right? I mean, the return is only going to be high if there's some level of risk that's also commensurate with that. So I would say it's not necessarily better or worse. It just depends on, what you're looking to achieve. If I would caution anybody that wants to dabble in options, don't dabble maybe, but really read up on them. As I mentioned, there's a lot of information that's free, that's available. Even a book you can get on Amazon. You can get one for really not a lot of money. Brokers, I get emails. I have a brokerage account. I get an email probably once a week about a free options seminar, that you can watch online, and that's like through Interactive Brokers, that one. And they're, I'm sure they're on video online. You can go to YouTube, you could learn about it. So I don't know that I certainly can say that options will not supplant stocks anytime soon. I mean, stocks are just so much bigger than options, even though, I've just spent the last 45 minutes talking about options have really, increased in volume. And it's true, they have, but, relative to stocks or even futures for that matter, they're still a smaller asset class. But it is something to consider. And if, particularly if you're an investor and you want to hedge your portfolio, they're a great tool for that. If you are a very confident trader and you understand options and you're sort of looking to day trade, you can certainly use them to do that. But I would, of course, say that you should really be careful when you do something like that, because the leverage factor of options is higher than that of stocks.
Yeah, and the thing is, like in options, you can be trading time, you could be trading volatility, you could be trading interest rates as well. So, it's not only about the stock per se. Most option traders, like day traders and so, what they're trading is not the stock, it's the volatility, right? Give me 1 second. You're in mute. 1 second. Sorry. I think you should be on mute.
Yeah, there we go. I saw a little pop-up come across. So, yeah. So market makers trade volatility. That's what we look at. We don't think about we do obviously think about the directional bet, but really more we think about how our position looks in a direction up and a direction down. Some increment. We tend not to think, because we tend to be delta neutral in terms of delta space. For those that are trading options, I remember watching a podcast, and actually was with Sheldon Natenberg, and it was like all about volatility. And so my answer is, if you're going to trade volatility, that's great, and you should do that. But there's a lot of professionals that trade it, and so he had mentioned the question was something along the lines of, how should we trade options, and what should be our driving force? And I think the guy was looking for him to say something along the lines of it, really like articulate about volatility. And he said something like, yeah, have a direction in mind. So like I think it's good advice is like, if to the extent you're going to trade options, you should be aware of the volatility, and you should be aware of the relative cheapness or expensiveness of them because of volatility. So, volatility now is at an elevated level relative to where it was 6 months ago. It's at a lower level relative to where it was a month ago. So having that in mind, it will make you a better trader. But I would say it's probably best to use them to express an opinion about which way you think the stock is going to move, rather than trying to express an opinion about which way volatility is going to move, because it's a much harder thing to trade, typically speaking.
I met Sheldon Nattenberger. I think I have a picture with him. It's a great speaker as well. So there's, what do you think about ERMB, the new Chinese crypto asset?
Well, I don't know much about it, so I can't speak to that one specifically. I could probably do a 2-hour session of this about cryptos and the Federal Reserve if you really let me let me off the off the reins. But cryptos in general, I can speak to and say, I think it's a risky product. I mean, uh, I, I would say cryptocurrencies are. I have not participated in the cryptocurrency boom, much to my chagrin, because in many respects, cryptocurrencies are what potentially could be a bubble that is tailor-made for me, which in fairness, my fear is, the monetization of the debt and, the Federal Reserve destroying the value of the dollar and fiat currency, obviously going to zero. And in fairness, I mean, if you don't have to look very far back, just a couple weeks, or even today, the Fed, yesterday, the Fed released an announcement about what bonds they're going to buy. And so I am very wary of fiat currency in general. I would say I am almost as wary, or potentially equally wary of cryptocurrencies. That's not to say that they won't exist in some form, but I think there are a lot of risks associated with them. The largest one being, well, I mean, it can't be a store of value necessarily unless it's a commodity. I mean, I would say I'm more in the gold camp. Again, it's not a bash on cryptocurrencies. It's just cryptocurrencies are unproven. Typically when things go bad, and if the fiat currencies were to start to fail, human history would say that we tend to go backwards for a spell before we go forwards. The last thing that worked was precious metals. It's worked for 2,000 years. I think you'll probably see a significant appreciation in precious metals. I personally have been getting longer precious metals over the last few years. And so, I vote with my feet on that. That's not to say that cryptos won't also see the same sort of rise. But it's dicier. It's unknown and it's unproven. And at the end of the day, there are many of the things that make fiat currency dangerous. You could make an argument are still there in cryptos, in that they can fork. There could be another crypto that supplants the one. What if something better than Bitcoin comes along, which is obviously the sort of the face of cryptocurrency now. So there are definitely risks associated with it. That's my 2-minute opinion on it. I would happily come back for a panel discussion another time to talk about that, because it's a much bigger topic. But yeah, I probably should cut it there. Otherwise, I'll just go on for forever.
We had a teacher from the University of Chicago talking about cryptos versus forex as well. So it's what's your view about robo advisories?
Sorry, about what?
Robo advisors?
Oh, yeah. I mean, I think it's fine. I think they're definitely disrupting the industry to some degree. I don't have I wouldn't say I have a huge opinion one way or the other. I don't, anything that I think is my general view is anything that's competitive in the space, that is that's coming in and offering a service that people like, I think is generally a good thing. To the extent that I think a lot of people might give flack to things that are new entrants, partially because they obviously have incentive to do that, or to maintain their own moat. But generally speaking, I think even things that don't necessarily work out probably have some sort of lasting effect on the industry. And I'm a trader after all. I'm sort of a free market guy when it comes to that stuff. So whether it's something like Robinhood, or any of these sort of passive things coming into the market, that's great. I mean, there have been volumes of books that have been written in the last 20 years about the benefits of particularly of passive investing, right? And so I do think the pendulum probably again is swinging pretty hard in that direction. But the market sort of corrects itself. It will correct itself. And so when the tide goes out, what is still standing and what is still here, I think will be strong. And so my feeling is generally anything that can compete, go for it. Throw it in the soup, see what happens.
Awesome. We really appreciate your time. It's great to hear you. Great to hear your stories and how you can describe how evolved from science. And we're not talking about 200 years or 600 years ago. It was just 20 years ago where people
Yeah.
were in there doing science and trading with it. And now talking about having towers between New York or whatever to the UK via microwaves. And it's, you lived it from one side to another one. So the technology actually has changed a lot, and it was great to hear all the journey and where are we now, and it's great. It's a very great topic, and I really appreciate your time, Andrew.
Well, thank you for having me. I appreciate this. Again, I think it's great, and it's generally a very good thing to have these sorts of presentations. But even now, the fact that you're able to organize these and do it over Zoom is even more important. So thank you for having me and for letting me be a part of it.
Thanks so much, Andrew. And do you want to tell us a little bit what that figure? I don't think if it's in Mexico. What's a prop trading?
Prop trading, and broadly speaking, I'm sure there would be a lot of definitions, but I mean,
there's no in Mexico. There's no like prop tradings are within banks.
Yeah, I would say trading for personal profit, I guess, would be the best description. I wouldn't think of a prop trading arm. Yeah, it would be different here. You wouldn't necessarily think of maybe you would call it a prop trading arm of a bank, but really prop trading is much more like private trading for personal profit, effectively.
Yeah. So
that's my best off the top of my head definition.
A firm that trades with their own assets.
Yeah, with their own capital, exactly.
Because in Mexico, there's not many, or there might be, but they're not very common. And in the US, you have a lot of small prop trading firms, which is not your case. It's a larger prop trading firm. But I just wanted to, maybe explain a little bit what it is and a little bit about your company as well. So I suppose you guys trade with your own funds.
Yeah, it's our own partner capital, and primarily options market making is the focus of Blackedge's trading. And there's several different asset classes. They got their start in treasuries for the most part, but have branched out, including my division is generally a relatively new division as of the firm. So they're branching out into different asset classes, which has been going great, and it's a great company to work for, and a lot of talented, smart people, good programming, good programmers, a good development team, good traders, and it's a company that's right in the sweet spot of growing and is big enough that able to compete with some of the larger players, but just growing very rapidly. And it takes a certain hunger to want to do that, particularly as a lot of trading has consolidated over the last few years. And so it's a very good firm to work for. But yes, to answer your question, it's all founder money, partner money. And so, yeah, we don't have any outside investors.
Trading and coding are becoming closer, right?
Mm-hmm.
Smarter.
Yes.
Skills on coding are, those traders are the ones that are right now more worth more than
it's definitely a skill that's high in demand. In fact, I learned it not that long ago, a few years ago. I had taken a few computer science courses in college, and so I had, I would say my background was virtually zero. I mean, it had been a long time since I'd actually coded anything, and I sort of made the decision, as I was deciding what to do next in my career, if I wanted to, just realized if I want to stay in this business, I mean, it's ever evolving. And I mean, you could probably say that about any business, but particularly trading just moves so fast. And so I learned Python. I know a little bit of a few other languages, but for the most part, most of my coding, I sort of like data analysis and research. And then, when it comes to handing off latency sensitive type things, we have a development team in our company here, and most companies are the same way, that actually handle that sort of thing as a full-time job. But when I came out of school, you had to be good at Excel, and I was great at Excel. And that skill is still valuable. It's really good. Excel is still a really powerful tool, but the reality of it is now everybody, it's like, how good are you at Python, or that, or a handful of other languages. And so yeah, I realized I had to get good at it. So I spent a lot of time learning it, and it really is empowering, because at the end of the day, you can really help yourself in so many different ways. Whereas before, I felt like I had to turn to a developer to help me with something, and now I can do 90% of the work and the research on my own, and then sort of hand off some, like at least a piece of it to, or like some form, some structure, to a developer who can then, it makes their job a lot easier, hopefully, to be able to implement it into something that's a little bit more application friendly. But yeah, it's definitely a skill, and anybody that's thinking about trading, there's so many free and inexpensive ways to learn coding. There's Code Academy. I used a course called from a website called Udemy. I found an instructor I liked, and it was I think I paid $10 for an entire Python course that was 40 hours of Python. I mean, I can't beat that. And it was very good. It had exercises and everything. It felt like a university course in many ways. So it's accessible, and it's not cost prohibitive. So anybody that's interested in doing it, I'd say start and just do an hour a day. If you do an hour a day for a few months, you'll be surprised at how quickly you can pick it up.
Awesome. Well, thanks so much again, and I know it's busy right now, and we took like the closing, I think, right?
Yeah, we're actually closed now. The U.S. equities are, so.
Yeah.
Well, I did the right at 3 o'clock, so there's some little after hours trading, but it was no problem at all. So again, thank you for having me. I really appreciate being able to participate in this.
I appreciate it. We will put it on YouTube, and we'll send you the link if you want to share it over
Okay,
there.
great. Yeah, that's wonderful. Thank you.
Thanks so much. Thanks everyone for joining, those on Facebook as well, and have a great one. Thanks.
Thank you. Take care.
Take care. Bye-bye.